let me tell you what State Street are saying. This is what Tim Graff said to me on the IB. Right now, the stars are aligning with the Fed, the ECB, the Bank of England, all easing by June or July against a backdrop of healthy labour market and cooling inflation. 'Tis nirvana. Mike Cudzil and Erik Knuzen are my guests this morning. Gentlemen, from a slightly more global perspective, I think Tim's based in London, so he has a slightly different perspective. But when I looked at fixed income markets, and this is, Mike, maybe to you first of all, are you tempted in this cycle is now starting post the SNB, and that perhaps global bond markets should be touched into as well?
Yeah, it's a great question. It's an area of focus for us for sure. We think, most likely, whether it was the Swiss last night or the BOE, the ECB, and the Fed, most likely they all get started around the same time. They all start cutting rates in the middle of this year, but that's where the similarities most likely stop. Speed and destination probably different across the globe, and that should create opportunities in global bond markets. So yeah, we find global bond markets quite attractive, maybe even more so than here in the United States, and that would include Australia, UK, German bunds, and so even Canada. And so all those markets pretty attractive. What you saw here in the U.S. was more of a fiscal impulse than you saw across the globe, and as well as kind of fixed rate mortgages here in the U.S. where monetary policy doesn't have the same bite, and as a result, you're starting to see a meaningful economic slowdown elsewhere, and that gives the central banks across the globe kind of scope to cut more than the Federal Reserve. So yeah, I think global bond markets are offering interesting areas of opportunity, and we're certainly engaged in those areas.
Lovely perspective. Speed and destination differs for everybody as of June. Erik, for you, what does it do to risk?
Well, I think it's not. There are some reasons why it may not be nirvana or some kind of discordant notes on the positive symphony, and those would be around term premium and real yields as you go out the curve, and also kind of thinking about expectations around structural inflation longer term. And the Fed raised that the resting point dot to 2.6% from 2.5, and 9 out of the 18. 9 out of the 16 dots were above 2.5. And so, that's a first indication that longer term inflation may be a little higher than, and the Fed is going to tolerate a little higher inflation over the longer term. And that's a different environment than what we've had, and perhaps a different environment that's being priced. And related to that is the expectation on our side and the need for higher term premium and real yields as you go out the yield curve. That's why we like the 2 to 7 year point of the yield curve, and from 10 years and out, we'd say 10 years fairly valued, and you're going to need to have more premium in there.